You want to know how traders survive? I'll tell you. It isn't the chart that saves them. It isn't even the entry. It's the size of the position. That's what makes or breaks the man sitting in the chair. You can have the right idea and still go broke if your size is wrong. You can be dead wrong and still live to fight another day if your size is right. Did you catch that? Think about it. Now, today we're talking about position sizing. And if you remember the previous video on how to trade high probability setups, you'll see this is the natural follow-through. Because what good is a high probability trade if you risk so much on one shot that you can't take the next one? I learned early that the market doesn't forgive arrogance. It doesn't care how sure you are. Every time you think you're too smart to fail, the market will slap you across the face. So the real key is not whether you're right today, but whether you'll still be here tomorrow. Tell me, do you want to win one battle, or do you want to stay in the war? I've seen too many fellows think they're clever. They hit a streak, start to believe they can't miss, and then they press too much. They size up beyond their means. And when the turn comes, as it always does, they're finished, all gone in one sweep. It's not the losing trade that destroys them, it's the size of the losing trade. Have you ever felt that sting yourself? The one that empties the account not because the idea was bad, but because you pushed too hard. Listen, a man's fortune is not built by being reckless. It's built by being patient, careful, deliberate. The stock market is a machine built to draw money from the impatient into the hands of the disciplined. And discipline in trading starts with size. You know, people always ask me, Jesse, what's the secret of staying alive in the market? And I tell them it isn't just in reading the tape, though that's crucial. It isn't only in spotting the trend, though that's the lifeblood. It's in making sure that when you're wrong, and you will be wrong, you're wrong small. Do you see what I mean? You keep your mistakes cheap. I'll say it plain. There's no reason to ever blow up if you understand size. Let me explain. When you risk only a fraction of your stake on each trade, you can string together a whole series of losses and still keep trading. And that's the game, staying in the ring long enough to let your big winners come through. That's where the wealth comes. Not from one home run, but from avoiding the knockout punch. Would you rather be the man who takes one big swing and ends his career, or the man who keeps swinging year after year, compounding his gains? Think about the psychology. A small loss doesn't rattle you much. You take it, you move on. A big loss. It cuts into your mind, your judgment, your courage. And trading without courage is as bad as trading without capital. So by controlling your size, you're also protecting your nerve. Now, let's put it into practice. Suppose you've got a stake of $10,000. The eager amateur will risk $2,000 or $3,000 on one trade. Maybe half his account. Why? Because he wants to get rich quick. But that isn't trading, that's gambling. And the house always wins against gamblers. The professional risks maybe 1 or 2%. $100, $200 at most. He knows the game is long. He knows he doesn't need to win them all. He just needs to keep taking good trades and let the arithmetic do the heavy lifting. Which one are you? Remember this, the market doesn't pay you for effort. It pays you for survival. And survival comes from avoiding ruin. A trader who risks too much is like a man driving a fast car without brakes. Sooner or later, there's a crash. You might say, but Jesse, if I size small, I'll never get rich. That's the thinking that ruins men. You don't need to get rich in 1 month. You need to stay solvent for a lifetime. Wealth is the result of compounding, not gambling. Every dollar you don't lose is a soldier kept for the next campaign. And every campaign gives you the chance to grow, slowly, steadily. That's how real fortunes are made. Not by risking it all, but by risking just enough. Do you see the wisdom there? I'll give you a picture. Imagine your account is your life raft in the middle of the ocean. If you cut holes in it by taking oversized positions, it won't matter how good your map is, you'll sink before reaching land. But if you protect it, patch it, keep it afloat, you can ride out any storm until the wind favors your direction. When I made my great trades, the kind people still talk about, it wasn't because I bet everything. It was because I kept my powder dry until the moment was right. And even then, I scaled. I added as the market proved me right. That's another secret. Don't put your whole stake in at once. Test the waters, add on confirmation. That way, your largest size only comes when you're already ahead. Tell me, isn't that smarter than shoving all your chips in before the dealer even turns the card? And this ties right back to what we talked about in that last lesson on high probability setups. You can have the best setups in the world, but they mean nothing if you can't size them properly. The probability is just theory until it meets your bankroll. If you bet too big, probability doesn't matter. A single loser wipes you out. If you bet right, probability works in your favor over time. That's the bridge between knowing the trade and living off the trade. Now, let's talk about the math for a moment, because math is the true backbone of size. Suppose your risk per trade is 1%. That means it would take 100 consecutive losses to ruin you. Tell me, do you think you'll ever hit 100 straight? No man ever has. But if you risk 20% per trade, it only takes 5 losers in a row to put you out of business. And believe me, 5 losers in a row happen to every trader alive. So which math would you rather live with? But don't fool yourself either. Small risk doesn't mean no discipline. You still have to cut the loss when it hits your number. Too many men think small size allows them to let it ride. That's a mistake. Small size is a shield, but you still need the sword of discipline. You cut quickly, you move on, you wait for the next clean entry. That's how you play the game like a professional. And let me remind you, because I see this mistake often, the size must always be in proportion to your capital. As your stake grows, your size grows. As your stake shrinks, your size must shrink too. If you lose, you trade smaller, not bigger. That's how you avoid the death spiral. Ever notice how most traders blow up right after they've been hurt? They lose, then double up to make it back. That's the gambler's ruin. The trader cuts back, slows down, preserves capital. Which camp do you want to be in? You may think this sounds dull compared to the thrill of taking a big swing. But dull makes you rich in trading. Excitement makes you broke. The tape is already wild enough. Your job is to stay steady while the crowd is losing its head, and nothing steadies a trader more than knowing his size won't wipe him out. So I ask you, are you approaching each trade as though your very survival depends on it? Or are you playing like the market owes you a living? Because I'll tell you a truth, the market doesn't owe you anything. It doesn't even notice you're there. You have to earn your right to play each day by keeping your losses small and your size reasonable. That's the only way you can stay in this game long enough to reap its rewards. Discipline in size equals freedom to trade the next opportunity. That's the whole secret in a single breath. The man who doesn't understand it is a prisoner to his own mistakes, chained by losses that were too big for his stake. But the man who does understand it walks into the market each morning with liberty in his pocket, because he knows he has the capital and the courage to act when the next real chance comes. You see, the freedom to trade is not some gift the market hands you. It's something you preserve with your own restraint. The average fellow doesn't think about freedom this way. He thinks freedom is the chance to go all in on the trade he feels sure about. He thinks freedom is betting big when he has a hunch. But that isn't freedom, that's shackles. Because if he's wrong, he isn't just wrong on the trade, he's wrong on his whole future. One bad turn, and he's finished. Tell me, do you want to be at the mercy of a single spin of the wheel, or do you want to know you'll always have another chance to step into the ring? It took me years to learn that freedom in the market is earned through discipline, not through daring. Every time I sized too large, I gave away my freedom. I tied myself to that one outcome. I couldn't think clearly because I was already too exposed. I wasn't making decisions anymore. The market was making them for me, and that's the most dangerous place a trader can stand. A man without control is not trading, he's gambling, and gamblers don't last. Think of the trader who keeps his size modest. He loses one trade, it stings but doesn't cripple him. He loses another, still he stands. Maybe he loses 3 or 4 in a row, but his account is still intact, his mind still sharp, his freedom still his own. Then comes the setup he's been waiting for, the one that lines up clean as day. And because he has the capital, because he has the nerve, he takes it. That one trade wipes out the small losses and carries him forward. That's freedom in action. It's the freedom to act when the tape finally says go. Now contrast that with the man who bets too large. One loss guts him. Two losses leave him trembling. By the time the big opportunity shows itself, he has nothing left to risk, or worse. He's too shaken to act. He let his oversized bets rob him of the chance to catch the move he was waiting for. Can you see how discipline gives you choices while recklessness strips them away? Freedom in trading is not just about money either. It's about mental space. When you know your size is under control, you can look at the tape with a clear head. You can read the market for what it is, not for what you hope it will be. A small risk keeps your judgment clean. A large risk clouds your vision with fear or greed. How many traders have you seen who stare at the screen frozen because they've bet too much? They can't cut the loss because it's too painful, and they can't hold on because they're panicking. That's not freedom, that's captivity. The irony is that men chase big size because they want freedom from working years, freedom from slow progress, freedom from waiting. But they grab at it too fast and end up losing the very thing they wanted. The truth is, discipline in size is the only way to reach that freedom. You build it trade by trade, campaign by campaign. You protect your stake so that it can grow, and as it grows, so does your freedom. Then one day you look back and realize you can trade without fear, because your account can weather the storms. That's real independence, not the illusion of it. When I think about all the accounts I've seen blown up, the story is always the same. It wasn't that the trader didn't know how to read a chart. It wasn't that he never picked a good trend. It was that he sized beyond his station. He put his whole fortune on the line for a single move. The market doesn't tolerate that kind of arrogance. The market punishes it quickly, and usually permanently. Those traders lost their freedom because they couldn't master themselves. A professional trader understands that every dollar in his account is a soldier. His job is to keep his army alive, because without soldiers he can't fight the next battle. He doesn't waste them on hopeless campaigns. He sends only enough into the field to test the ground, and if the ground proves favorable, he reinforces. But he never sends the whole army at once. That's how you keep the freedom to fight again tomorrow. Do you see the point? The discipline is what gives you options. Ask yourself this: would you rather risk everything for a single chance, or would you rather guarantee that you can keep taking chances for as long as you live? Most traders answer the first in their hearts, even if they won't admit it. They want the rush. They want to feel like they're conquering the market in one stroke. But that is vanity, not trading. The man who thinks he's conquering the market will soon learn that the market conquers him. I'll tell you another thing about freedom in trading. It gives you patience. When you know your stake is safe, you don't feel the need to chase every flicker of the tape. You can sit, wait, watch. You can pass on setups that don't measure up. You can wait for the right conditions. But when you've risked too much, you're desperate. You start jumping at shadows, grasping at every wiggle, because you can't afford another loss. That desperation is the death of sound judgment. Freedom only comes from discipline, because discipline gives you time. Think back to what I told you in the last discussion about high probability setups. Those setups don't appear every hour, not even every day. Sometimes you must wait, sometimes you must do nothing. But how can you wait if your capital is tied up in oversized bets that keep bleeding you? The man with discipline in size can wait as long as it takes, because he knows his losses will never eat him alive. The man without it has no patience, no freedom to wait, and so he never sees the best moves at all. It all comes down to control. Control of capital, control of emotions, control of decisions. Discipline in size is the lever that gives you that control. Without it, you're just another leaf blowing in the market's wind. With it, you're the sailor who can steer his ship regardless of the storm. You can cut the sails when the wind is wrong, and you can set them full when it turns right. But you can only do that if you're still afloat. Oversize your trades, and you sink before you ever catch the favorable breeze. Some traders complain that risking 1 or 2% feels slow. They want to see big returns now. But ask yourself, is it really slow? If you keep your risk small, you get to keep trading day after day, month after month, year after year, and those years compound. The man who risks small grows steady wealth. The man who risks big either wins a fortune once or loses everything, usually the latter. Which path is truly faster in the long run? Which path truly delivers freedom? So I'll say it again in plain language: discipline in size equals freedom to trade the next opportunity. That's not just a slogan. That's the essence of professional speculation. It's the rule that separates the men who last from the men who vanish. It's the difference between watching the market from the outside, broken and bitter, or playing it from the inside, calm and confident, knowing you'll always have another chance. Scaling into trades after confirmation is safer than going all in up front. That single principle separates the professional from the amateur, the survivor from the casualty. Too many traders think they need to bet big the moment they see something they like on the tape. They feel if they don't put the whole stake down at once, they'll miss the chance. But that kind of thinking belongs in a casino, not in the market. In the market, you don't need to gamble, you need to align with the truth of the trend, and the truth of the trend only reveals itself in time. That's why the smart operator scales in. He starts with a probing line, a small size, and then only adds when the market proves him right. The tape doesn't always tell you the whole story at the beginning. The first move might be a head fake, a little play to lure in the eager money before the real direction shows itself. If you've gone all in on that first move, you've tied your entire fortune to a story that may not hold. And when it breaks against you, you've got no room to maneuver. But if you've only dipped in, you can step aside with a small scratch and wait for better clarity. Tell me, wouldn't you rather be the man who tests the water before diving than the one who jumps headfirst into shallow rocks? Scaling is about patience and discipline. It's about recognizing that the market doesn't owe you speed. The best moves unfold over time. You don't have to be the largest at the start, you have to be positioned when the tide becomes obvious. That's when you add, that's when you press. Every big campaign I ever made was built this way. I never shoved my whole role in at the beginning. I built the position piece by piece as the market carried me. By the time I was at my largest, the market itself was already paying for my risk. That's how you play with house money, not with your own neck on the line. Think about the psychology. When you scale, your first entry is small enough that you can think clearly. You're not sweating over every tick. If the trade works, you add always in the direction of strength. Each addition is confirmed by the market's own behavior. You're not guessing, you're following the tape. And if the trade fails, you lose little because you hadn't gone in full size yet. That's freedom. That's control. And that's how you build courage in trading, not by swinging for the fences, but by letting the market itself give you the green light. Most traders do the opposite. They front-load their size. They bet heavy right away because they want the thrill of being right from the start. But this is pride, not strategy. Pride demands that you prove yourself instantly. Strategy demands that you wait for the proof. And the market punishes pride without mercy. If your first bet is your biggest, you've left no room to adjust, no room to grow, no room to adapt. You've burned your powder on the opening skirmish, and if it turns against you, you're finished before the real battle begins. Do you see how dangerous that is? Scaling also protects you from the false breakouts, the fake trends, the traps that catch the unwary. The tape is full of deception. A stock can look strong for an hour, a day, even a week, before it reverses. If you've gone full size at the start, you're vulnerable to every trap. But if you scale, you can survive the false start. You can take the small loss on the probe and keep your capital intact for the real move. The difference between the professional and the amateur isn't that the professional never gets fooled. It's that his losses are small when he does. Scaling makes sure of that. Consider the arithmetic. Suppose you want 1,000 shares in a position. Instead of buying all 1,000 at once, you start with 200. The stock moves in your favor, confirming your read. You add 300 more. The trend continues, volume confirms, and you add another 300. By the time you take the last 200, you're already ahead. The market itself has financed your later size. If you're wrong, you cut out after the first or second entry, losing a fraction of what you'd have lost if you bought the full 1,000 at once. Which method gives you a longer life in this business? Scaling in also sharpens your tape reading. Each partial entry gives you new information. You see how the market reacts to your buying. You see whether volume expands. You see whether resistance holds or breaks. With each step, you're not just committing capital, you're gathering intelligence. The all-in trader never gets that information because he has no flexibility. He's married to the position from the start, blind to what the tape is telling him afterward. Scaling keeps your eyes open, your judgment clear, your hands steady, and don't think scaling means timidness. Far from it. Scaling is the most aggressive method once the trend confirms. Because by the time you're at full size, you're pressing into strength, riding momentum that's already proven itself. You're not guessing. You're reinforcing a winning position. That's how campaigns are built. That's how fortunes are compounded. It isn't about one heroic entry, it's about building a fortress position on solid ground. There's also a mental advantage. When you scale, you can sleep at night. You're not tossing and turning over a massive exposure you shoved in at the open. You know your risk is measured, your loss is controllable, and when the market moves in your favor, you feel confident to add because you've earned the right to. That confidence is priceless. Without it, traders second-guess themselves. They cut winners short. They sabotage their own gains. Scaling builds the confidence that lets you hold on to the big move when it finally comes. And let's not forget, scaling teaches you humility. It reminds you that the market is bigger than you, that it doesn't reveal its secrets all at once. By scaling, you admit you don't know everything up front. You're willing to wait for confirmation, to let the tape prove itself. That humility is the mark of the professional. The amateur wants to declare victory on the first move. The professional waits until the battle is clearly won, and then he commits his strength. That difference is everything. Now tie this back to risk. Scaling naturally keeps your early risk small. It's like testing the ice before you walk out on the lake. If it cracks under your foot, you step back, no harm done. If it holds, you move further, step by step, until you know the surface is strong. By the time you're standing in the middle, you have confidence that the ice will bear your weight. The man who sprints out without testing, he's the one who falls through and never comes back. Which man do you want to be? Think, too, about compounding. The real wealth in trading comes from letting winners run. Scaling allows you to let them run with size. You don't need to hit full size at the beginning. You need to build into the winner as it proves itself. That's how you end up with your biggest positions in your best trades. Isn't that the essence of successful speculation, having your largest exposure where you have the greatest edge? Scaling is the mechanism that makes that possible. Position sizing is the trader's first line of defense against ruin. It is not a detail to be worked out after the fact, nor is it a mathematical trick to squeeze more juice out of a system. It is the very foundation upon which a trading career rests. Without it, no edge can survive. With it, even a modest edge can grow into lasting wealth. Every trader learns this sooner or later, though most learn it the hard way by losing too much too soon. The market is merciless with those who forget the importance of size. You can pick the right trend. You can read the tape as sharp as any operator. You can sit with patience and courage, but if your size is wrong, none of that will matter. The wrong size magnifies your mistakes and drowns your judgment. The right size, on the other hand, gives you room to breathe, to think, to wait for the next chance. Tell me, what good is a perfect entry if it costs you your whole stake when the tape turns against you? The truth is that most traders think about profit first and size second. They dream of how much they can make if the move runs their way. They rarely ask how much they could lose if it doesn't. But the professional flips this order around. He asks first, how much can I afford to risk? How much size allows me to stay in the game, even if I'm dead wrong? Only after answering that question does he place the trade. That is why professionals last and amateurs vanish. Imagine two traders watching the same setup. One risks half his account on the move. The other risks 1%. The setup fails. The first trader is crippled. His account is gutted, his confidence shot. He may never recover. The second trader shrugs, records a scratch in his journal, and looks forward to the next day. Same trade, same idea, same chart, two completely different outcomes because of size. Doesn't that make you pause? Position sizing is not just about mathematics, it is about psychology. A small position keeps your emotions under control. You can take the loss without fear, you can ride the winner without greed. A large position hijacks your nerves. Every tick feels like life or death. You tighten stops too soon, or worse, you freeze when you should act. Discipline becomes impossible when your size is too large. The tape becomes your master instead of your servant. When I was young in the bucket shops, I saw it again and again. A fellow would start small, win a few trades, feel confident, and then load up on the next one. That oversized bet would always be the one that broke him. He didn't lose because he was wrong. Everybody is wrong sometimes. He lost because he was too big when he was wrong. If he had kept his size small, he would have lived to try again. Instead, he went broke. How many times do you think that story has repeated in the market? Thousands. Tens of thousands. The beauty of position sizing is that it puts the odds of survival in your favor. If you risk 1% per trade, you can be wrong 50 times in a row and still have half your account left. Now tell me, what are the odds you'll be wrong 50 times in a row? Vanishingly small. But if you risk 20% per trade, just 5 losers in a row will end you. And every trader alive knows that 5 losers in a row are always around the corner. That's the arithmetic of survival, plain and simple. But it goes further. Proper sizing allows compounding to work. Wealth in the market is not built in a day, or even in a month. It is built through years of steady play, letting winners add up, letting the account grow slowly but surely. Each dollar preserved is a soldier in your army. Each soldier fights another day. Blow them on oversized bets, and your army dwindles before the real battle even begins. Protect them with smart sizing, and soon your army is large enough to march into bigger campaigns. Some traders think small sizing means small ambition. They complain it's too slow, that they'll never get rich risking 1 or 2%. But that's a misunderstanding. It isn't about being timid, it's about being strong enough to last. A man who risks small can keep trading for decades, through booms and busts, through good streaks and bad. His edge compounds quietly, and one day he wakes up wealthy. The man who risks big either hits a jackpot once or loses it all. Which of those paths really sounds faster in the end? Consider the mental freedom that comes from correct sizing. If you know you're only risking a fraction of your account, you can trade without fear. You can let go of the outcome of any single trade, because you know your survival doesn't depend on it. That frees you to follow your system with discipline, to read the tape without bias, to wait for the right setups. Oversized positions chain you to hope and fear. Correct size gives you freedom, and think about flexibility. With proper sizing, you can take multiple trades, you can diversify, you can test new ideas without risking ruin. Oversized bets lock you into one idea, one hope, one outcome. If it fails, you're finished. If you size small, you're never married to a single position. You can cut, adjust, re-enter, build, scale. The market is a moving target, and you need the flexibility to move with it. That flexibility is only possible when your size is under control. Even the greatest campaigns, the big winners, everyone remembers are built on sizing discipline. No professional piles in his entire stake at the start. He tests the waters, starts with a fraction, and then adds as the market proves him right. Each addition is financed by profits from the earlier lines. By the time he's at full size, he's already ahead. That's how you grow a small probe into a massive winner without ever risking annihilation. That's position sizing in action. Now, ask yourself, why would a trader ever blow up if he truly understood size? The answer is, he wouldn't. A trader can always survive by keeping his bets small enough. He might lose, he might go through drawdowns, but he won't be destroyed. Destruction comes only from ignoring size, from letting greed or fear dictate position. That's why I call sizing the first line of defense. It's the wall that keeps ruin outside the gates. Without it, every mistake floods straight into the account. With it, mistakes bounce off harmlessly while you wait for the real chance. I've always said that the market pays the man who can sit tight. But you can't sit tight if your position is too large. You'll be forced out by fear, by margin calls, by the sheer weight of the loss. Proper size lets you hold through the natural noise and ride the true trend. It gives you staying power. Without it, you're a weak hand shaken out at the first wobble. With it, you're the strong hand that stays for the main move. Isn't that the difference between the losers and the legends? Think back to that last lesson on high probability setups. If you've ever stood on a trading floor at the opening bell, you know the feeling. It's a storm, a rush. The noise is so thick you can almost reach out and grab it. And in that storm, if you don't learn how to listen, if you don't train your eye to catch the faintest glimmer, you'll miss the signal that matters. Now, I'm not talking about the chatter you hear from the crowd or the tips that fly around like confetti. No, I mean the signals the market itself gives you before the papers print the story, before the crowd knows what's going on. And let me ask you something right at the start. If you could read those signals earlier than the next fellow, what would that be worth to you? The market, my friends, is always speaking. Always. It's a living, breathing creature. It tells you what it's about to do if only you'll bother to listen. Trouble is, most folks don't listen. They think they know better. They rely on hope, on guesses, on tips. But the market doesn't care about your opinions or mine. It doesn't care what the newspapers print. The market moves first. The reasons come later. You see, if you wait for the reasons, you'll always be late. Haven't you noticed that? I learned long ago, if you want to survive in this game, you've got to read the tape. And I don't just mean staring at the ticker. I mean learning to sense the pulse in the price action itself. The market tips its hand, ever so slightly, if you're sharp enough to catch it. That's what I call early signals. They aren't shouted at you. They're whispered. Do you have the patience to hear a whisper when everyone else is yelling? Think of it this way. You're watching a stock that's been quiet. Not much doing. Then, suddenly, you notice small buying coming in, nothing spectacular, just a steady demand that keeps showing up. The price ticks up, not by leaps, but by nudges. It doesn't fall back the way it used to. That's the market sending you a telegram, plain as day. Now, most traders shrug. They say, oh, it's nothing. But then, a week later, the stock is running, and they ask themselves, why didn't I see it? You ever asked yourself that after watching a move you missed? Here's the truth, the big moves always begin in silence. Like the first tremor before an earthquake. And if you wait until the whole town is shaking, you're too late. That's why I tell every trader who wants to last in this game, learn to recognize accumulation and distribution. Those two words are the heart of this business. Accumulation is when the smart money is quietly buying up stock while everyone else is asleep. Distribution is when they're unloading it to the crowd after the move is already underway. The early signal is in that quiet shift. Are you following me so far? Let me give you an example. Back in my day, when I watched Union Pacific, I noticed weeks of small, steady purchases. Nothing dramatic, but the stock wouldn't go down, no matter what the market was doing. That told me something. It told me someone with real money was taking all the stock that came on the market. They were building a position. They were preparing for something. I didn't know the reason yet, and I didn't need to. The reason didn't matter. The signal was enough. Now ask yourself, would you rather trade on reasons or on results? The crowd loves reasons. They love stories. They'll tell you a dozen explanations for why a stock should go up or down. But the market doesn't move on stories, it moves on orders. It moves on buying and selling. That's the only law that matters. And when you see the buying begin before the headlines, that's your edge. Do you see why the signal always comes first? Now, don't mistake me. Early signals are not about jumping at shadows. The market throws out plenty of head fakes. If you chase every tick, you'll be broke by Friday. What I'm talking about is a pattern that builds over time. Consistency, a change in behavior. You've got to train your eyes like a hunter watching for tracks in the snow. One footprint might mean nothing, but a trail that's your signal. Have you ever noticed how a stock starts acting different before the news breaks? Here's a simple truth, the insiders, the people who know, they always act before the news gets out. Always. They can't help it. If a company is about to land a big contract, somebody starts buying. If a company's in trouble, somebody starts selling. And those somebodies aren't fools. They've got money, and they use it. Their footprints show up in the tape. The trick is to learn how to see those footprints when they're fresh, not after the whole street has marched over them. Wouldn't you like to catch that kind of trail early? I'll tell you something else. Early signals aren't just in the price. They're in the volume. Price is the market's voice, but volume is the market's breath. You ever watch a stock move up on heavy volume? That's the market shouting. But the whisper comes when the volume begins to swell just a little, quietly, before the move. It's like a campfire before the blaze. A spark, then a flicker, then a flame. If you wait until the forest is burning, you'll never get the best of it. Haven't you ever wished you bought in before the rush? And let's not forget the market loves to fool you. It's a master at deception. It will run up a stock just to shake in the amateurs, then knock it down and take their money. But the real signals, the ones that matter, they don't vanish after a day. They build. That's why patience is the rarest quality in this business. Everybody wants action, but action without understanding is suicide. Can you sit still long enough to see the pattern develop? I remember when I was a young trader, I thought every wiggle in the market was a signal. I was jumpy, always chasing the next move, and I paid for that education dearly. But over time, I learned to separate the noise from the music. Noise is what the crowd hears. Music is what the smart money plays. You've got to tune your ear. Early signals are like the opening notes of a tune. If you know the melody, you can recognize it before the whole orchestra comes in. Ever caught a song in the first bar and knew exactly what was coming? Now, some of you might be asking, how do you tell a real signal from a fake one? That's the great puzzle, isn't it? There's no easy answer, no formula you can paste on your wall. The market doesn't give you certainties, only probabilities. But here's what I know: a real signal has persistence. It doesn't vanish overnight. If a stock is under accumulation, it will keep showing strength day after day, even when the market wobbles. That's your clue. It's not one day's action, it's the character of the move. Do you see the difference? And here's another thing: never fight the general market. You can have the best signal in the world, but if the tide is going out, you'll drown. Early signals always appear first in the broad averages, not just in individual stocks. You watch the leaders, the generals, the ones that set the tone. When they start to weaken, that's not noise, that's a signal. And when they start to firm up before the rest, that's also a signal. Have you been watching the generals or just the camp followers? The market speaks in whispers before it shouts. That's the plain truth of it, and most men miss it because they are waiting for the fireworks, waiting for the cannon, instead of listening for the faint crackle of the fuse. The whispers are there every single day, but you have to train yourself to recognize them. They are not grand proclamations. They are not painted in bold letters across the financial pages. They are quiet, almost invisible to the untrained eye. And yet, if you catch them, you are already a step ahead of the crowd. Let me ask you, how often have you wished you'd known a move was coming before it arrived in full glory? When I say whispers, I mean the subtle changes in a stock's character. It may be a little firmer tone to the bids. It may be a reluctance to drop in price when the whole market is soft. It may be a slow but steady swell in trading volume without any news to justify it. Each one on its own seems insignificant, but together they form a whisper that tells you something is happening here. Do you see the difference between noise and a whisper? Noise is loud and distracting, but a whisper is focused, deliberate, and meant for those who are paying attention. The crowd wants shouts. They want big moves and big headlines. They want the excitement of knowing why something is happening. But by the time the market is shouting, by the time the headlines are written and the experts are explaining, the move is already well along. The best money has already been made. The whisper is the earliest clue, the soft turning of the wheel before the ship visibly changes direction. Have you ever noticed how the crowd only becomes interested after the easy part is gone? Think of a stock that's been drifting along uninspired, unremarkable. Then, out of nowhere, the behavior changes. Buyers appear more regularly. The stock refuses to go lower even when offered. That is the market whispering to you. It's not screaming, "Buy now!" It's not promising anything. It's simply hinting, leaving a trail. You need the patience and the discipline to lean in and listen. Can you discipline yourself to notice small details others ignore? I've watched countless traders chase after shouts. They read the newspapers, they listen to tips, and they wait for confirmation that the crowd is already moving. They want certainty, but certainty in this game is expensive. By the time you're sure, you've already lost the edge. The whisper is uncertainty dressed as opportunity. You won't know for certain, but you'll see the signs before anyone else. Isn't that where the profits are before certainty becomes obvious? Let's talk about why the whispers come first. It's because the people who know, the insiders, the professionals, the ones with real information and real money, they move quietly. They don't announce themselves. They accumulate stock carefully, so as not to drive the price too high too soon. Their footprints are small but steady. That's the whisper. The crowd never notices until the buying becomes obvious, and then it's too late. So I ask you, do you want to follow the crowd, or do you want to follow the footprints that appear before the crowd even looks down? The whisper might also come from the market itself, in the broad averages. You might see strength building in the leaders while the general list still looks heavy. That's not an accident. That's the whisper of a turn, the beginning of a shift in trend. The market never changes direction without telling you first. But it tells you in whispers, not in shouts. The shouts come later, when everyone is convinced. Wouldn't you rather catch the beginning of the turn instead of the end? Patience is what makes a whisper audible. If you are restless, always looking for action, you will miss it. The whisper takes time to become a message. You must watch day after day, comparing today's action to yesterday's, the week's pattern to last week's. Slowly, the picture sharpens. A stock that was weak begins to show resilience. A sector that was ignored begins to see steady buying. The whisper becomes a murmur, and if you are sharp, you act before the murmur turns to a shout. Do you have the patience to let the picture reveal itself, or do you demand instant proof? Let me give you a scene. Picture yourself at the ticker, the tape, rolling. You notice a stock that should be falling with the market, but isn't. You see buyers taking every bit of supply that comes out. No surge, no panic buying, just steady hands absorbing the stock. That's a whisper. If you are too busy chasing the wild moves elsewhere, you'll ignore it. Weeks later, that stock is running and everyone is piling in. They hear the shout. You had the chance to hear the whisper, but did you listen? Another whisper is when a stock sells off on bad news, but doesn't break the way you'd expect. It holds firm. The selling dries up. That's telling you the smart money is quietly stepping in, absorbing the weak hands. The crowd will still be nervous, still talking about the bad news, but the tape is already whispering that the worst is over. Do you trust what you hear in the tape, or do you trust what you read in the papers? Whispers aren't only in individual stocks. They're in the tone of the whole market. Before a bull market begins, you'll often see the leaders strengthen first. The whispers are in the generals while the soldiers still lag. Before a bear market begins, the generals weaken, even while the averages are still making highs. That's the whisper of distribution. The smart money is unloading, and the crowd is still cheering the highs. Which side do you want to be on, the one that hears the whisper of weakness, or the one that waits for the shout of collapse? Now, don't mistake whispers for certainty. They don't guarantee the move. They only tilt the odds in your favor. You can't demand perfection from a whisper, but what you can do is recognize that the market is never silent. It always signals, faintly at first, then loudly. If you wait for the loud signal, you're late. That's the lesson. So I'll ask you again when you trade, are you waiting for the market to shout, or are you training your ear to catch the whisper before anyone else? Leaders tip their hand before the crowd notices. That's a truth you can set your watch by. In every market cycle, in every great move up or down, the leaders always show their colors first. The trouble is, most men are looking in the wrong place. They watch the averages, they watch the headlines, they watch the noisy laggards at the back of the line. But the real signal is in the generals, not the foot soldiers. Let me ask you, if you were marching into a battle, would you keep your eyes on the raw recruits stumbling in the rear, or would you watch the captains up front who know where they're going? A leader is a stock that sets the pace. It doesn't follow the market, it directs it. These are the issues that make new highs before the averages that show strength when everything else looks tired. When the bull market is about to begin, the leaders are the ones that first break out of their ranges. When the bear market is around the corner, the leaders are the ones that first falter, even as the averages look strong. They tip their hand. But you have to be watching closely to notice. Have you trained yourself to look at the generals, or are you distracted by the noise in the ranks? I've seen it countless times. The tape will show a handful of leading stocks making fresh advances, strong as steel, while the rest of the market is still sluggish. That's no accident. That's smart money moving in advance of the crowd. It's their footprints. The leaders tell you the next chapter before it's written. The crowd, blind as ever, waits for the averages to confirm, for the headlines to declare a new bull run. But the leaders were whispering weeks before. Don't you want to be among the few who catch that whisper instead of chasing the shout? Let me give you an image. Picture a great ship at anchor. The tide is turning, but the ship doesn't swing all at once. First, the bow shifts slightly, then the whole vessel follows. The leaders are the bow. They're the first to turn. The rest of the market is the heavy bulk that follows later. If you're sharp, you see the bow swing before anyone else notices. And if you wait until the entire ship has swung around, well, the easy part of the move is already gone. Can you spot the first turn before the crowd does? When leaders tip their hand, it isn't by accident. These are the stocks the professionals crowd into, the names that attract the first and fastest capital. You don't have to ask why. You don't need the story. The tape tells you the truth. It shows you steady accumulation in the leaders before the market as a whole takes off. You might see them making higher lows when the rest of the board is flat. You might see them rally stronger after each dip. That's their hand tipping. But most men ignore it because it doesn't fit with the averages they worship. Have you ever noticed how the crowd insists on being blind to the obvious? The same is true at the top. Leaders crack before the rest. Always. They start stumbling, failing to make new highs, showing weakness even while the papers are still filled with optimism. That's the canary in the coal mine, and yet the crowd doesn't see it. They're too busy celebrating the new highs in the averages, ignoring the fact that the generals are slipping. When the leaders fall out of line, the soldiers will follow. Isn't it better to know before the retreat turns into a rout? Now, you must understand, not every strong stock is a leader. True leaders stand out over time. They command attention by the consistency of their action. They're the first to surge, the first to resist declines, the first to recover. They carry the market on their shoulders. You'll recognize them if you train your eye, because they act differently than the pack. But to see it, you need to stop chasing the noise. Can you discipline yourself to watch for character instead of chasing excitement? I'll tell you something else. The leaders don't just tell you about themselves, they tell you about the whole market. A handful of leaders advancing strongly, while the rest of the list drags, tells you strength is building under the surface. A handful of leaders breaking down while the averages look fine tells you weakness is creeping in. The leaders tip their hand, and in doing so, they tip the hand of the entire market. Why wait for the laggards to confirm what the leaders already showed you? Volume plays a role here too. A leader on the rise will show strong demand, steady accumulation, heavier trading on up days than on down days. That's no coincidence. That's real interest. That's the smart money at work. You don't need to know who's buying. You only need to know that someone with capital is stepping in. That's a signal. When you see it across a group of leaders, you know the tide is changing. Do you really need a newspaper to tell you what the tape is already whispering? I've seen men ruin themselves by ignoring the leaders. They'll say, the averages are strong, so everything must be fine, even while the generals are collapsing one by one. They trust the mass instead of the signal. But the averages are nothing more than the sum of their parts, and if the parts that matter are cracking, the whole will crack too. Leaders tip their hand early because they are where the real demand and supply first shows up. Don't you think it makes sense to watch them instead of the blind crowd? The crowd waits for confirmation. They want the safety of the herd. But safety in the market is an illusion. By the time it looks safe, it's already too late. The leaders don't wait for confirmation. They move first. If you move with them, you have the chance to ride ahead of the herd. If you wait for the herd, you'll pay dearly. So the question becomes, do you have the nerve to trust the signal in the leaders, or do you need the comfort of the crowd? Leaders tip their hand before the crowd notices because they are the place where the truth is revealed first. The professionals who know, the insiders who act, they concentrate their power in those names. Their footprints are visible in the price and volume of the leaders long before the story is told elsewhere. All you have to do is watch carefully. But most traders would rather be entertained than attentive. They want excitement, not observation. They want noise, not whispers. But the leaders don't shout. They whisper first. And that's where the edge lies if you're listening closely enough. Price action reveals truth long before news does. That's a lesson every trader learns sooner or later, usually the hard way. The market doesn't wait for newspapers, it doesn't wait for analysts, it doesn't wait for explanations. The market moves first, and the story comes after. If you're waiting for the story, you're late. And yet, isn't it strange how men cling to stories? They want reasons, they want justifications, they want a neat little package that explains what's happening. But the market doesn't deal in reasons. It deals in results. Let me ask you, would you rather be right with reasons or rich with results? Every tick of the tape is the record of buying and selling. That's all it is. No opinions, no forecasts, no editorials, just facts. A stock trades up or it trades down. That's the truth. Everything else is interpretation. And if you watch closely, if you learn to trust what the price is telling you, you'll see the truth before the rest of the world has a clue. That's the advantage of the trader who listens to price instead of chatter. Have you ever noticed how the tape was already telling the story before the papers printed it? Think about it. A company's about to announce a strong quarter. Do you really think the price just sits still until the press release hits? Never. Someone always knows. They may not shout it from the rooftops, but they act. They buy. And that buying shows up in the price long before the story breaks. You'll see strength. You'll see resilience. You'll see a steady bid underneath the stock. That's the truth. The story you read later is just the excuse the crowd needs to jump in after the fact. Which side do you want to be on? The same thing happens on the downside. A company's got trouble brewing, maybe poor earnings, maybe management issues, maybe a deal falling apart. You think the price doesn't show it, it always does. Selling starts quietly, the stock weakens when it should be firm, it fails to rally when the market lifts. Those are the facts. That's price action revealing the truth. By the time the news hits, the stock has already fallen, and the crowd is left asking, why didn't we see it? Haven't you asked yourself that question before? Price action is the purest signal because it strips away the noise. Everyone has an opinion. Everyone has a theory. But nobody can argue with the fact of a trade. If a stock is climbing, it means more buyers than sellers at that price. That's truth. If it's falling, it means more sellers than buyers. That's truth. You can dress it up with explanations, but the reality is already there in the price. Do you trust the truth of the tape or the stories in the paper? I learned long ago that the tape never lies. Traders lie. Analysts lie. Newspapers lie. Hope lies. But the tape doesn't. It doesn't care about your opinion, your forecast, your hopes, or your fears. It just records the facts. Price action is the earliest signal of what's really happening. It's the market whispering, "Here's the truth," while the rest of the world waits for the news. Wouldn't you rather listen to the whisper than wait for the echo? Now, the crowd hates uncertainty. They want to know why something is happening. They want confirmation. That's why they wait for the news. But news is always late. Always. By the time it's published, the smart money has already acted. The insiders have already bought or sold. The truth was already in the price. If you need the comfort of an explanation, you'll pay for it by being late. Do you want comfort, or do you want profits? You might be watching a stock drift higher on no apparent news. The crowd shrugs it off. They say it's nothing, just random. But the tape tells you otherwise. The tape tells you there's steady buying pressure. Maybe the world doesn't know why yet, but the truth is there in the action. Weeks later, the news breaks new contract. Earnings surprise, merger talk, and the stock explodes. The crowd rushes in, too late, but you saw the truth in the price before the story was told. Do you see how much of an edge that gives you? On the other side, you'll sometimes see a stock falter even as the news is glowing. The papers are full of praise. Analysts are raising targets. The crowd is buying in, but the price action tells a different story. The stock won't advance. It sells off on good news. That's the market telling you the truth the insiders are distributing, handing stock to the crowd before the trouble comes out. The truth is in the price, not in the words. Have you noticed how often price action disagrees with the news, and how often price proves right? One of the hardest lessons for a trader is to trust the tape over their own opinions. You might think a stock should go up. You might have every reason in the world. But if the price action shows weakness, that's the truth. Ignore it at your peril. The market doesn't care about what you think should happen. It only cares about what is happening. And what is happening is written in the price. Do you fight the tape, or do you follow it? Price action reveals truth because it reflects real decisions with real money. Talk is cheap. News is just talk. But when someone puts capital on the line, that's action. That's commitment. And those commitments, multiplied across thousands of trades, create the movement in price. That's why price action is the only reality. Everything else is just a story layered on top of it. Wouldn't you rather trade on reality than on stories? I've seen markets rally in the face of bad news. I've seen them collapse in the face of good news. That tells you all you need to know about the value of stories. If the price is moving against the story is wrong. The truth is already in the action. Smart traders learn to stop asking why and start asking what. Not why the stock is moving, but what the stock is doing. Because the what is the fact, the why is the theory. Which would you rather rely on? If you train your eye, you'll begin to notice how often the truth shows up first in the leaders. A handful of stocks will begin to climb steadily before the market as a whole turns. That's price action tipping you off. No news yet, no stories, just the truth showing itself in the tape. Weeks later, the headlines catch up. By then, the move is half over. The whisper of the price was there all along. Did you hear it? Price action is also the only tool you can use in real time. News comes after the fact. Fundamentals take time to gather. Opinions are endless. But the tape is immediate. It tells you right now where the buying and selling are. It tells you right now the truth of the market's mood. That's why traders who live by the tape always have the edge over those who wait for the story. They see the truth as it happens, not after it's dressed up for the crowd. Wouldn't you rather act with the truth in hand than react to a story after the fact? Patience turns noise into a melody you can recognize. That is one of the hardest truths for most traders to accept, because patience is a quality few men naturally possess. The market is full of noise, ticks, wiggles, rumors, chatter, headlines, opinions. Every day the tape is alive with movement, and the temptation is to jump at every flicker as though it were meaningful. But most of that is just static. It confuses you, wears you down, makes you act when you shouldn't. Only patience can separate the real signal from the background noise. Have you ever jumped into a trade too soon, only to see that if you had waited a little longer, the truth would have revealed itself plainly? Noise has a way of seducing the restless trader. It looks like opportunity. A stock runs up a point on heavy trading and suddenly the whole room is excited. But patience tells you wait, see if it lasts, see if it's real. The impatient man buys on the noise and ends up trapped in a false move. The patient man lets the market prove itself. The difference between the two is not intelligence but discipline. Can you discipline yourself to sit on your hands when the market is full of sound and fury? The melody, as I call it, is the underlying trend. It's the theme that carries through the day-to-day fluctuations. But to hear it, you need to quiet your mind and give the market time to play it out. If you lean in too soon, if you demand instant clarity, you'll mistake a passing note for the song itself. The market doesn't reveal its tune in an instant. It plays it slowly, testing you with false starts and reversals. Patience is what allows you to hear the difference. Do you want to hear noise, or do you want to hear the song? I've sat for days watching a stock do nothing, listening to men around me complain about the boredom. They want action, any action, even if it's meaningless. But I've also seen that same stock, after weeks of dullness, suddenly spring to life in a move that carries for months. The melody was building all along, but only the patient trader caught it. The impatient ones were too busy chasing noise elsewhere. Isn't it curious how often boredom is the seed of profit? Patience also teaches you that one day's action rarely tells the whole story. A stock might break out one afternoon, only to fall back the next morning. You know, people are always asking me, how do you predict the next breakout trend? How do you catch that big move before everyone else sees it? And I always smile, because that's the wrong question to begin with. You don't predict the market. You don't sit there with a crystal ball and try to divine what's coming tomorrow morning. What you do is recognize conditions that tell you when the market is preparing to move. That's all you can ever really do. And if you think you can outguess the tape, you'll be ruined sooner or later. Tell me, haven't you seen traders blow up because they were so sure the market would do what they expected? The first thing you have to understand is this price is never random. It moves because of forces, real forces, that push it along like the wind carries a ship. Those forces are supply and demand, fear and greed, money flowing in and money flowing out. And when those forces build up long enough without release, you get a breakout. Think of it like a boiler. Pressure builds and builds and builds. At some point it must let out the steam. Now, do you want to be the fellow who waits until after the boiler has burst and all the noise has frightened the crowd? Or do you want to be the fellow who saw the pressure mounting and positioned himself before the explosion? Most people wait. They need to see it to believe it. They buy after the breakout has already run, and they sell after the breakdown has already dropped. They let their emotions dictate their trades. But the operator who survives, he doesn't wait for confirmation from the crowd. He watches the tape, he reads the action, he listens to what the market is whispering before it shouts. Haven't you noticed how the market always tips its hand, if only for a moment, before it makes a big move? Now, I'll tell you something. In my early years, I used to think that if I could just memorize enough patterns, I'd have the secret. I'd sit with my notebook, drawing formations, triangles, flags, cups, whatever they call them nowadays. But it wasn't the shape itself that mattered. It was the psychology behind it. Why does a stock form a tight range? Because buyers and sellers are fighting for control, and neither side has the upper hand. Why does volume dry up? Because the weak hands are gone, waiting for something to happen. And when that balance finally tips, the move begins. Isn't it obvious once you think of it that way? Let me give you an example. Suppose a stock has been climbing steadily, stair-step fashion, and then it stops. It doesn't collapse, doesn't reverse hard, but it just sits there, trading in a narrow band. The amateurs get bored. They say, "This thing isn't going anywhere, I'm out." But I see that as potential, because strong stocks rest before they continue, and weak stocks break down. The trick is to distinguish one from the other. That's where patience comes in. Do you have the patience to sit and watch a stock that does nothing, waiting for the moment when it does everything? A breakout is never an accident. It's the natural result of pressure building up in the market. If you pay attention to the tape, you'll see the footprints, the big orders stepping in quietly, the support holding firm, the way the stock refuses to go down even when the market is weak. Those are the clues. That's the market tipping its hand. But most traders are too busy chasing the action elsewhere, looking for excitement. Tell me, haven't you ever sold a quiet stock only to watch it take off without you the next week? There's another point, and I want you to listen carefully. Breakouts only matter in the direction of the trend. I've seen too many traders try to catch a bottom, calling a reversal as if they were fortune tellers. They see a stock that's been falling for months, and they tell themselves it must bounce. And when it does bounce, they shout, "See, I knew it," but then it rolls over and sinks to new lows. That wasn't a breakout, that was a trap. The real money is always in line with the path of least resistance. If a stock has been trending higher and then tightens up, you watch for the breakout upward. If it has been sliding lower and then forms a base, you watch for the breakdown downward. Isn't it foolish to swim against the tide when the current is so strong? Now, don't misunderstand me. Recognizing a breakout isn't the same as trading it well. I've known traders who spotted the right move but lost money anyway. Why? Because they rushed in too early or they waited too long. Timing is everything. The best breakout trades are entered at the precise moment the market confirms the pressure has been released. Not before, not after. That means you don't guess. You don't anticipate. You prepare. You watch. And when the signal comes, you act without hesitation. Can you do that, or will you second-guess yourself and miss the chance? I'll tell you the hardest part: sitting still. Most people think trading is all action, pushing buttons, buying and selling all day long. But the real skill is waiting. You might study a stock for weeks, even months, before the right moment comes. And when it does, you strike. But all that time in between, you sit, you watch, you keep your money safe. It's like a hunter waiting in the brush. The prey doesn't come out because you want it to. It comes out when it's ready. How many times have you taken a trade out of boredom, only to regret it? Another thing I've learned when the breakout comes, it must be obvious. Obvious not to you, but to the whole market. The volume surges. The price clears resistance cleanly. The stock doesn't hesitate or stumble. It just goes, and the crowd rushes in, pushing it further. That's when you ride the wave. But if you have to squint at the chart to convince yourself it's a breakout, then it isn't one. Haven't you ever forced a setup, only to realize afterward that you were just seeing what you wanted to see? What makes the big difference is discipline. You can know all about breakouts, trends, supply and demand, but if you lack discipline, the knowledge won't save you. Because the market will tempt you every day. It will show you near breakouts, fake moves, head fakes, noise. And if you bite every time, you'll bleed slowly until you're finished. Discipline means you wait for the right conditions, and when they come, you act big. That's how you make money. 1 or 2 big moves a year can pay for all the waiting, all the false starts, all the mistakes. But you must be there, ready and willing. Isn't that what separates the speculator from the gambler? I want to talk about risk for a moment. People get excited when they see a breakout, and they forget that even the best-looking move can fail. A breakout without follow-through is a trap, and it will catch the eager every time. That's why you never risk more than you can afford to lose. You place your stop where the trade proves you wrong. If the breakout is real, it will never come back to stop you out. If it does, then you are wrong, and you take your small loss. But too many traders hold and hope. They think it'll come back. And maybe it does once or twice, but eventually the big one comes along and it doesn't come back. And then it's all gone. Haven't you seen that happen? Here's something else. The best breakouts come when the general market is in your favor. You can find a beautiful setup, but if the whole market is weak, you're fighting against the tide. The greatest trends always ride on the back of a strong market wave. So you don't just study your stock, you study the whole market. You read the tape of the averages. You look for strength or weakness in the broad trend. Because no stock stands alone for long. Don't you think it's easier to sail when the wind is at your back instead of in your face? People ask me if there's a secret indicator, some hidden formula that reveals the next breakout. I tell them the only indicator that matters is price and volume. Everything else is just noise. Price tells you what the stock is doing. Volume tells you who is behind it. When price breaks out on heavy volume, you know the big money is moving. And when the big money moves, it drags everything with it. You can't fight it. You just join it. That's the real secret. Don't you find it strange how traders complicate things with fancy tools when the truth is right there in the tape? Now, don't think for a moment that predicting breakouts means you'll catch every one. You won't. Sometimes you'll miss them. Sometimes you'll get shaken out. Sometimes the market will fool you. But you don't need them all. You only need the big ones. The ones that pay for everything else. And those big ones, they don't come along every day. That's why you have to be patient. Why you have to wait. Why you have to train yourself to see clearly without bias. Because when the big one comes, it changes everything. Haven't you noticed how a single stock can go from obscurity to a household name in just one breakout trend? Let me tell you something about human nature. The crowd never changes. 100 years ago, they panicked and rushed just the same as they do today. They chase tops, they dump bottoms, they follow the noise. That's why the same principles still work. Because you're not trading numbers on a screen, you're trading human behavior. When you learn to see that, the chart becomes more than lines. It becomes a story. The story of fear, greed, hope, despair. And every breakout is just another chapter in that story. Do you see it that way, or do you still see only patterns? The funny thing is, the moment you think you've mastered it, the market will humble you. It'll throw a false breakout at you, lure you in, and then slam you down. And if you let your ego get in the way, you'll double down and lose everything. The market doesn't care who you are. It doesn't care how smart you think you are. It rewards discipline and punishes arrogance. That's why the best traders never boast. They know they're only as good as their last trade. Have you ever felt that sting of overconfidence when the market teaches you a costly lesson? The way to survive, the way to thrive, is to approach every breakout with humility. You recognize the setup, you take the trade, you manage your risk, and you let the market do the rest. If it goes your way, you ride it as far as it'll take you. If it doesn't, you get out quick. Simple as that. But most people can't keep it simple. They overthink, they overtrade, they overstay. And the market takes back what it gave them. Why make it so hard when the path is clear? I've spent my life watching markets, and I can tell you with certainty, the next breakout trend is always forming somewhere. The only question is whether you'll see it, and whether you'll be ready when it comes. The clues are there in the price action, in the volume, in the market tone. But you have to be looking with a clear mind, free from bias, free from emotion. Because the market doesn't care about your hopes. It doesn't care about your fears. It only cares about supply and demand. Haven't you felt how liberating it is when you stop trying to outguess the market and just follow the tape? Now, let's go a little deeper into how you spot those pressure points before the breakout. You'll notice that strong stocks don't just break out from anywhere. They usually do it from a base. A base is a period of consolidation where the stock builds strength. The longer the base, the bigger the move when it breaks out. It's like coiling a spring. The more you compress it, the farther it jumps when you release it. So when you see a stock building a long, tight base, you pay attention. Because when it goes, It won't creep, it'll leap. Don't you find it remarkable how often the biggest winners had the longest, quietest bases beforehand? But you can't just buy because it's in a base. You have to wait for the breakout. The breakout is your signal. Until then, it's just potential. I've seen traders buy too early, convinced they're smart enough to get ahead of the move. And sometimes they're right. But more often, the stock dips. They get shaken out, and then it breaks out without them. They tried to be smarter than the market, and the market punished them. Isn't patience cheaper than being too early? Volume is your confirmation. A breakout without volume is like a fire without heat, it won't last. But when you see price clearing resistance with a surge in volume, that's when you know the big money is stepping in. Institutions, funds, operators, they're the ones who move stocks, not you or me. And when they commit, you want to ride with them. Haven't you noticed how the real trends always have volume behind them? Sometimes the breakout happens on news. A strong earnings report, a new product, a big contract. The crowd rushes in, and the stock explodes higher. But don't be fooled, the news is just the excuse. The real move was already building in the tape. The stock was already strong, already under accumulation. The news just lit the fuse. That's why you don't need the news. You need the tape. The tape tells you before the news does. Haven't you seen a stock rally on bad news or sink on good news simply because the trend was stronger than the headline? The hardest part, and I'll repeat it because it's so important, is sitting tight. When you've got the right stock, in the right trend, breaking out at the right moment, you don't fidget. You don't sell at the first tick against you. You sit. You hold. You let the market do the heavy lifting. Because the big money is always made in the big swing, not the little wiggles. That's the difference between trading for a quick buck and trading like an operator. Do you have the stomach to sit through the normal shakeouts and let your profits grow? I've seen too many men take small profits and big losses. They clip their winners short and let their losers run. That's backwards. You should cut your losses quick and let your winners ride. A breakout trend is your chance to make a fortune if you have the courage to hold it. But if you keep selling for crumbs, you'll never feast. Isn't it ironic how fear makes men sell the right trades and hold the wrong ones? And remember, every breakout has its end. Nothing goes up forever. The same way you spot the beginning, you must watch for the signs of exhaustion. Volume drying up on the rallies, heavier selling on the declines, failure to make new highs. Those are the warnings. That's when you tighten your stop, protect your profits, and prepare for the next opportunity. Because the market is a cycle of breakouts and breakdowns, booms and busts. Do you see it as a cycle, or are you still chasing each move as if it were the last? So when you ask me how to predict the next breakout trend, I tell you it's not prediction, it's preparation. You study the tape, you study the market, you recognize the conditions. You wait for the pressure to build, you wait for the release, and then you act. And if you're wrong, you get out quick. If you're right, you hold on for all it's worth. That's the game. That's all there is to it. The rest is just noise. And right now, as I speak to you, somewhere out there in the market, a stock is coiling tight, building pressure, waiting for the moment when it'll break free. The tape will show you the clues, if you're watching carefully. The question is, will you be ready when it does? Discipline. That's the word that separates the men who last in this game from the ones who are chewed up and spit out by the market. Everybody wants to know the trick, the hidden formula, the magic signal that'll point them to the next fortune. But the truth is, all the rules, all the methods, all the setups are useless without discipline. Because what good is knowing the right play if you can't bring yourself to execute it the right way? Haven't you seen fellows who can talk charts and patterns all day, but when the bell rings, they act like gamblers at a racetrack? Think about it. The market is designed to test you, to pull at every weakness in your character. It will tempt you to chase when you should wait. It will lure you to hold when you should cut. It will tease you with little profits, daring you to grab them just before the big move you'd been waiting for finally begins. And if you don't have discipline, you'll fall for every trick. Do you know why? Because the market isn't just numbers, it's a mirror of your own emotions. Now, most men believe discipline means tightening your belt, grinding your teeth, and forcing yourself to follow rules you don't believe in. That's not it at all. True discipline comes from knowing exactly what your method is, believing in it through experience, and having the patience to wait for the conditions you know are right. It's not about willpower, it's about conviction. But conviction only comes from testing yourself in the market over and over until you know the truth of it. Haven't you noticed how the traders who survive the longest aren't the loud ones shouting about their wins, but the quiet ones who stick to their plan like clockwork? Let me tell you a story. I've watched many a man get rich quick on a hot streak. Maybe they caught a wild bull market, maybe they got lucky with a big bet. They make money so fast their heads spin, and then, flush with confidence, they forget discipline. They double down, they start breaking their own rules. They think the market has blessed them with some special genius. And then the tide turns, the inevitable shakeout comes, and in 1 or 2 trades, they give back everything. You see, the market will let you win without discipline for a little while, but it won't let you keep those winnings. Haven't you seen how fast easy money disappears? Discipline means cutting your losses without hesitation. That's the hardest act in speculation, because it feels like admitting you were wrong. But every man is wrong sometimes. Even the best operator in the world is wrong plenty. The difference is, the disciplined trader knows being wrong small is just part of the business. He takes the small hit and lives to fight another day. The undisciplined one lets pride get in the way, holds on, averages down, and turns a scratch into a disaster. Which one are you? And discipline isn't just about losses, it's about holding your winners too. The crowd loves to grab a quick profit, take the small gain and feel clever. They tell themselves, I'll lock it in before it slips away. But the real money is made by sitting tight in the right trade. The disciplined trader waits for the move to unfold, for the trend to play itself out. He doesn't sell just because he's nervous or because the price dips for a day. He knows the difference between normal fluctuations and a true change of character. That knowledge is useless without discipline to act on it. Haven't you ever sold too early, only to watch the stock double after you were out? Discipline also means waiting. The best trades don't appear every day. Sometimes the market is messy, uncertain, noisy. The amateurs force trades out of boredom. They say, I have to do something. But the disciplined trader knows he only has to act when the market gives him a fat pitch. Until then, his capital stays safe. He waits, he studies, he watches. The hardest work in speculation is doing nothing. But that nothing is what saves you and sets you up for the big strike. Can you sit idle when the market gives no signal, or do you jump in just to feel alive? Then there's discipline in size. A trader without discipline bets too big when he feels good, too small when he feels scared. He lets his emotions decide his risk. But the disciplined man has rules for size. He risks a set portion, not too much, not too little. He knows that survival comes before profits, and survival depends on never risking ruin. A single bad trade shouldn't put him out of the game. That's why discipline in size is so vital. Haven't you noticed how greed makes men reckless right before the market humbles them? And don't forget discipline in studying the tape. Most traders glance at a chart, convince themselves of a story and jump in. The disciplined operator studies, compares, waits for multiple signs to align. He doesn't marry his opinion, he tests it against the market's action every day. If the action changes, he changes. He's not stubborn. That's discipline too. Flexibility is a form of discipline, because it's easier to cling to your idea than to admit the market has proven you wrong. But the market is always right. Isn't it strange how many traders would rather lose money than admit they were mistaken? There's another kind of discipline that nobody talks about: emotional discipline. You can have rules written on paper, but if your nerves can't handle the heat, you'll break them. Discipline means training yourself to stay calm when others panic, to stay patient when others rush, to stay humble when others boast. The tape will test your nerves every day. It will shake you, taunt you, exhaust you. The man without emotional discipline will always fold at the wrong moment. Haven't you felt your heart race during a wild swing, urging you to act when you should have stood still? Discipline is also about simplicity. The crowd clutters their minds with a dozen indicators, 100 opinions, endless noise. They confuse themselves until they see signals everywhere. The disciplined trader cuts it down to what matters: price, volume, trend. He ignores the rest. He knows that more information doesn't mean better decisions, it just means more excuses. Simplicity takes discipline, because it's tempting to believe the answer lies in some complicated formula. But the truth is, the more you strip away, the clearer the picture becomes. Do you see how the amateurs drown themselves in data while missing the obvious? Above all, discipline is the only real edge you can count on. Markets change, setups evolve, conditions shift. But discipline never goes out of style. It's what keeps you in the game when everyone else is wiped out. It's what allows you to capitalize on the big moves when they come. Without it, you're just another gambler with a short lifespan. With it, you have a fighting chance to build something lasting. And the funny thing is, most men know this. They nod their heads when you tell them discipline is key. But knowing isn't enough. The test comes in the heat of the moment, when the market moves against you, or when profits tempt you. That's when your discipline shows or fails. And I'll tell you, this discipline isn't something you master once and keep forever. It's a battle you fight every day. Every trade is a chance to slip, to break your rules, to let emotion take the wheel. You have to renew your discipline constantly, like sharpening a blade. One lapse can undo months of good work. The market is relentless that way. It doesn't forgive weakness. Haven't you noticed how one careless trade always feels bigger than 10 careful ones? So when I say discipline is the only edge that survives every market cycle, I mean it. Methods may change, tools may evolve, but discipline endures. Without it, you're doomed to repeat the same mistakes. With it, you give yourself the chance to stand apart from the crowd, to survive long enough for fortune to favor you. But only if you can live it, not just preach it. Because in this game, it's not what you say, it's what you do. When the tape puts you to the test, patience pays, boredom kills accounts. That's a truth as certain as the sun rising tomorrow. The market has a way of making a man restless, making him feel that he must always be doing something, always trading, always moving his money around. But the irony is, the best trades are often born out of long waiting, not constant action. Haven't you noticed how the fellows who trade every hour of every day are the ones who always seem short on capital when the real opportunity finally shows up? You see, speculation isn't about action, it's about timing. And timing is about patience. The crowd doesn't understand that. They want excitement, they want the thrill of buying and selling. They treat the market like a gambling hall, a place to find entertainment. But this isn't entertainment. This is war. And in war, you don't waste your ammunition shooting at shadows. You wait, you watch, and you strike when the enemy exposes himself. Isn't it true that a soldier who fires too soon or too often finds himself out of bullets when the real battle begins? Most traders fail not because they can't read a chart or because they don't know about breakouts or trends, but because they don't have the patience to wait for the market to align with their plan. They see a setup that almost fits, and they convince themselves it's good enough. They act out of boredom, because sitting still feels unbearable, and the result is always the same: small losses, wasted energy, a drained account, all because they couldn't stand the silence between real opportunities. Haven't you ever taken a trade just to keep busy, only to watch it chip away at your account while the trade you should have waited for passes you by? Patience isn't glamorous. Nobody brags about the days or weeks they sat on their hands, doing nothing while the market chopped around. But that's the work of a true operator. To wait with discipline, to let the crowd exhaust itself chasing every wiggle, while you conserve your strength for the moment when the tape speaks clearly. Patience means being content to let 100 mediocre trades go by in order to catch the one that matters. Can you resist the urge to act, to gamble, when the market gives you nothing but noise. And boredom, that's the killer. Boredom makes men reckless. They start fiddling with small trades, convincing themselves they're keeping sharp when really they're just feeding the market. They start looking for reasons to enter, twisting charts and inventing signals. They say, it looks good enough, but good enough isn't good enough in speculation. Only the best setups, the clearest breakouts, the strongest signals are worth risking your money. Everything else is just temptation. Haven't you noticed how boredom always whispers, just one trade won't hurt, right before it turns into a string of losses? I've seen boredom ruin fortunes. Men who had the skill, who knew the game, but who couldn't stand waiting. They'd rack up small losses out of impatience. Then, when the real move came, they either had no money left to take it, or they were too demoralized to see it through. The market demands patience, but it doesn't hand it out freely. It tests you. It lulls you into a trance, makes you feel like nothing will ever happen again. And then, when you least expect it, the breakout comes. Only the patient man is ready. Do you see why waiting is harder than pulling the trigger? Patience also means letting trades develop. Too many sell the moment a trade shows them a small profit, as if they were starving for crumbs. They waited long enough to get in, but not long enough to reap the rewards. The real profits take time. A breakout trend doesn't unfold in a day. It needs weeks, sometimes months, to deliver its full potential. Patience means holding through the small dips, the shakeouts, the noise, and trusting your plan. Haven't you seen traders exit a stock for a quick 5%, only to watch it run 100% without them? The market rewards those who can do less, not more. That sounds strange, doesn't it? But it's the truth. The fewer trades you take, the more selective you become, and the better your odds of hitting the big one. The man who trades every day has no patience. He spreads himself thin, chasing every idea. The man with patience may take only a handful of trades a year, but those trades, chosen carefully, can make his fortune. Isn't it remarkable how the busiest traders are often the poorest, while the patient ones quietly accumulate wealth? Patience means enduring discomfort. The waiting is painful. You'll feel doubt creeping in. You'll feel like you're missing out while others are busy trading. You'll be tempted to abandon your plan and jump at scraps. That's when patience is hardest. But that's also when it pays most. Because while the crowd is busy burning itself out, you're preserving yourself for the real opportunity. Haven't you noticed how the best setups always appear right after the crowd has lost interest? Boredom is nothing more than your ego demanding entertainment. The disciplined trader ignores it. He knows his edge doesn't come from activity, it comes from precision. He waits for the exact setup, the clean breakout, the perfect alignment. Then, and only then, he acts. Every trade before that is a tax paid to boredom, and boredom charges interest. How many accounts have you seen drained not by one bad trade, but by 100 little ones, born out of restlessness? Patience isn't passive. It's not sitting idly with your eyes closed. It's active observation. It's studying the tape, watching the price action, noting the accumulation, the drying up of supply, the tightening of ranges. It's preparation.